Welcome to the Gray Report. I'm your host, Spencer Gray. If you're a multifamily investor, you're active, you're passive, maybe you're just working in the industry, you're a participant, and you want to know, hey, where is this market going? What's going to happen in the multifamily industry? Well, luckily, you're in the right spot. Thanks for being here on the Gray Capital YouTube channel or wherever you get your podcasts. We do this every single week, breaking down the latest in multifamily, commercial real estate, housing market, taking a look at the macro economy, and just pulling the latest research reports, data, and opinions to try to make sense of this uncertain, crazy world that we all live in. Griffin's here again, as he is every single week, producing the Gray Report with me. You want to stick around for the whole show because we sometimes save the best for last. That's where the filters go wide open and we just start cranking. So make sure you're subscribed, leave a comment, stick around. This is going to be a good one. Let's get into it. All right, welcome back to the Gray Report. Griffin, how you doing this week?
Awesome. Doing great. The weeks are flying by. It's another Tuesday in Indianapolis. We're in the podcast studio. It's a really good quantifier of time passing.
It is.
It's going by too quickly. It's almost March.
It is almost March. As we all know, February is a shorter month, but it still surprises me every year. One day I'll remember.
Right. How are you? I don't ever ask you that. How are you doing? You've had a heck of a day today.
It's all part of the job. It's been great. I mean, it's what I like. I mean, two of the things I enjoy doing the most, which is looking at real estate and sitting here with you, Griffin, and doing this podcast. I'm talking about real estate. So yeah, I was up in Fort Wayne, Indiana, looking at some multifamily acquisition opportunities. Two beautiful looking assets. We'll see what happens. The pricing out there, it's challenging. Again, assets that are high quality, great locations. There's going to be a lot of interest, and so it's stuff that we'd love to buy. But trying to maintain really tight discipline, but also being aggressive when it's necessary. And really, the biggest challenge is being data driven and knowing the data like too well, like knowing where rent growth is, knowing where supply is. And the reality is that we're in a slow growth market right now, supply overhang. It might take a little bit longer to kind of get us back to some solid footing, although there's some potential green shoots in some of the reporting, maybe, but there's a big difference between, did things pick up during 2026, even the latter half, or is it more of a 2027? And there's no data that says when and how much. Just we have historical examples of every time rent has behaved like it has been, there's typically a strong pickup afterwards. But we can look at cycles as evidence, but to say, okay, well, rent growth will be, whether is it going to be 2, 3, 4, 5%? We've achieved 5% rent growth or higher in many of our assets.
Right.
Where others, we're seeing, negative rent growth to, maybe slightly positive. So we know it's possible, but we need to be realistic because the difference between 2 and 5 is massive. And the other challenge we're running into on all these value add properties, which I think there's a big opportunity. I love buying brand new stuff when we can get it at the right price. A lot of buyers haven't wanted to go after B-class properties built prior to 1990. Partially because they got bid up so much and they don't want to deal with it. But if I can find something in a good market, good demographics, it's growing, good schools, that doesn't have functional obsolescence or physical obsolescence. So property we're in today, private entrances, no common hallways. You don't have trash spilled over, in the hallway. It smells. Someone's cooking, smoking. You can smell what everyone else is doing.
Right.
That's completely eliminated. It feels more like your home. So you open the door, you walk right in. We found that residents just really like that experience versus kind of common hallways. It's less stuff to clean, et cetera, et cetera.
Right.
But the challenge is the new supply in the market, new construction that's being in lease up right now, their rents are only about $250, maybe a little bit less compared to this mid 1980s product. And so the plan the brokers are saying spend $15,000. You don't even have to spend that much. Spend any kind of money. Call it $5,000 to $15,000. Pick your poison. The more money you spend, typically the higher rent premium you need to get to justify the spend to get the return on investment. If you can't spend all that money upgrading a unit and not get some sort of lift. And so what they're asking us to do, or the idea, and this isn't this broker shop. This is the market. This is what everyone's saying to do right now to justify, to get the numbers that the current owners want. Is like, look, spend the 10 grand, the 15 grand, move rents $200 and $250, and that will allow you to get a 13 to 15 IRR, with no fees, no economics. But if you acquire it at where we want to sell it, or where the seller wants to sell it.
Yeah.
And we're looking at it and say, so you think that the 2000 or the 1985 property that is renovated, but it's built in 1985 with popcorn ceilings, will achieve the same rent as the 2024 built with all the fancy bells and whistles and amenities. It's like that the dog doesn't hunt. It doesn't make sense.
Yeah.
And so what the plan, like, I think it's really straightforward what like an asset like this needs. You fix what's broken, which they've already done a lot of that. Not replacing things that you really don't need to, because the goal is to make money, but it's easier to make money if we are targeting demographics that can afford to live there. And so if we don't want to price ourselves out of the market, especially when there's newer competition. And so where's like the sweet spot of like keeping rents like reasonable, so we're targeting like a big chunk of the population but still getting a good ROI. So like if we could go in there and again fix what's broken, swap out the carpet in the common areas for like LVP on turns, because that's lower maintenance over time, it looks better, etc. Maybe swap out some lights, maybe you swap out like the sink and the plumbing hardware, and that's really it.
Sure.
But we're just trying to get organic rent and maybe a little bit more than organic growth, because we're still fixing things up a little bit.
Yeah.
But that deal doesn't pencil what they want to sell it for.
For listeners that are maybe not as keenly familiar with the Fort Wayne market, maybe at all, what's the growth story in Fort Wayne? What's Gray Capital's general interest in Fort Wayne? It's an hour and 2 hours from Indianapolis, so it's close by.
Yep.
Other than that, we had 2 C-suite executives go up to Fort Wayne, essentially with our acquisition specialists. We sent a team up there, so we're obviously interested. What is it about Fort Wayne that captivates our eye?
Great question. So it's one of the stronger growth markets in the Midwest. I mean, it's posting certainly rent growth numbers that the Sunbelt would have been jealous, a couple of years ago. It's got good population growth, good job growth. It's the second largest city in Indiana. It's only from the north side of Indy. It's 90 minutes away.
90 minutes, okay.
Maybe 2 hours from like the south side of Indy. But so for us, we're managing our own properties, so geographic proximity is key, because that allows us to just manage things more effectively and efficiently. If we need to surge staff, maintenance, leasing, whatever, we can send folks from our corporate office or our other properties that are nearby and supplement operations. And just it's easier to get to. Just practically, it's easy to operate.
Right.
But again, growing dynamic economy that's really steady. So a ton of healthcare. There's some higher education, but GM has a massive presence. General Dynamics, Vera Bradley, some of the larger industries, and then it's pretty diversified, across other industries and businesses. But growing downtown, growing suburbs, good schools. You're talking to the folks up there in Fort Wayne. They're like, it's an hour and a half to Indy. It's like 2 hours. It's 3 hours to Cincy. It's maybe 2.5 hours to Chicago, to 3 hours from Chicago.
Yeah, it's got to be fairly close. I know it's close to Michigan, Ann Arbor. Yeah, Detroit.
So they're like, we can go to lakes up in Michigan. So there's those regional proximity to a lot of different things. And then there's also things going on in Fort Wayne, restaurants, culture, music. but you're not in like a big city. I think there's the people who live there appreciate not being in Chicago, and some probably don't, like appreciate not even being in Indianapolis. The perception is just like a bigger city.
There's a little regional airport in Fort Wayne as well, so it does allow for some regional travel, air travel.
Yeah. Sweetwater is also another big company. Yeah,
Right.
and I think about that because the owner of Sweetwater is big in aviation, and he owns a lot of like the heliports across the.
Cool.
Or
Second largest city in Indiana. That was new to me. Maybe could have guessed it, but I wouldn't have.
And so it's one of the other. It's one of the few markets we're not already. We don't have a presence in Indiana. And it's one of the best markets to get into. It's not from a lack of trying. I mean, I've invested as an LP in some deals in Fort Wayne, and we did really well. So I'm trying to get great capital in that market. It's always been on the list. We just haven't been able to make anything pencil. But the market's tough. It's always challenging. One of the reasons why we're going to Fort Wayne again is because Indianapolis. We love Indianapolis. We want to keep buying in Indianapolis, but it's getting more competitive all the time. And we have to do deals that make sense. And the pricing on some of the deals in Indy doesn't make sense. I mean, Flats at Stones Crossing, this A-class, basically 2024 construction property that we bought on the south side of Indianapolis, suburban Indianapolis, that now looks like an absolute steal.
Yeah.
I mean, the price per door of new similar properties it's tens of thousands of dollars more per unit, and for a product that's not even doesn't have as strong of demographics. They're in areas that are seeing more supply coming online. So feel great about that and all the other deals in Indianapolis, but trying to buy into that, especially newer properties where we bought flats, close to call mid 220s a door. Now there's properties coming out for 250, 260, 270 a unit. And are they that much nicer? Not really. Are they in a better location? No, not really. But we're also not going to pay close to $200 a door for like a mid 80s or 90s built product also.
Right, that needs more capital infused into it for those CapEx projects.
Exactly.
Yeah.
So I mean, we'd love to buy the brand new stuff when it makes sense, but because of that, everyone else does too. And so we're like, okay, well maybe no one wants to buy the 80s stuff because a lot of people have a line in the sand in 1990. And people might not be looking at Fort Wayne because they just aren't familiar with it. People aren't really familiar with Indianapolis or not thinking about Indiana. And I don't know how many people think about Fort Wayne, like ever. They probably have heard of it, but like, what do you know about Fort Wayne? You just ask,
I live about an hour and a half away, and I don't think about Fort Wayne very much. So maybe I should start.
But people do think about it. And they're moving there, and there's jobs, and employers are moving there for a variety of reasons. So it's, but we'll again, we're going to be on to the next one the next week. Probably not going to win these, just one after the other, trying to buy right and not get over really aggressive where it doesn't make sense. But when we see something that works, and again, the challenging piece is just like knowing we're probably going to get some growth like later on, but not having exactly knowing where to put a pin in it.
Sure.
And so like that just opens up the opportunity to make some errors. But then like you in your gut, sometimes you're looking at it and it's like, oh, this makes sense. And the cap rates are starting to look more attractive. Like we're seeing like mid fives, like even, I want to say mid sixes, but that's usually where we are until the prices get bid up. Yeah. We're seeing deals in mid five caps. We've seen some deals in mid sixes.
Okay.
Those again are often bidding the price up, cap rate down.
Yeah.
It's tough out there, but we should jump into the jargon bin. That was everyone got a little deal, not even preview, just a little day in life. What's going on?
Market talk, but the jargon bin's next up. What are we talking about this week?
Preferred return, Griffin. It's something. It's a component of many deals, but it's another often misunderstood, misused term that is a core component to most private equity deals and most real estate private equity deals, and it is the next one on our list.
So I just before we start talking about preferred return, I remember the very first investor call I got on.
Yeah,
and we had we've already talked about IRR, we've already talked about cash on cash, we've already talked about equity multiple. Then we had preferred return, and there's all these different numbers on the screen. And you have to define what preferred return is. And the individual I was talking to basically equated, and we're going to get to this, in the word guaranteed return. That is not what preferred return is. And so when you see an LP investor that takes a look at the preferred return, it says, oh, this is a guaranteed return. There's no such thing as a guaranteed return, but what is the preferred return and why is it not guaranteed?
Well, one, we just don't even like to use the language guaranteed.
No, we do
not that we don't want, not that we don't have conviction in something. It's just from like an SEC perspective, it's not good because there's just things that you can't control. And it's not a guarantee. It's not like it's not a debt obligation either. So a preferred return, it's a minimum return that typically investors or limited partners receive prior to the GP, the general partner, or the sponsor starting to receive a return or a split, starting to participate in the profits themselves.
Okay.
There could be more details, but very plainly, minimum return that the investor gets before the GP starts making money.
So if there's let's just call it an 8% preferred return
Yep.
on a project. As an LP investor, I'm taking a look at that. Based on what you said, that means that I must receive an 8% return on my investments before the general partner or Great Capital can receive any kind of cash flow or potential profit from the investment.
Yeah, correct.
Understood. What does that, let's just use that 8% preferred return mean? That's an annual number?
Yeah, typically it's an annual return,
Okay.
typically cumulative, so it doesn't compound. And again, it's typically before that sponsor kind of gets into the money or starts receiving their carried interest or the promote. And you can think of it as like who's first in line to get money.
Okay.
I've got my preferred payment. I'm the preferred, like I've got my preferred return. It's in preference over the GP and anybody else other than, the debt. And so, but for example, let's say you don't have enough money to pay the whole preferred return, the sponsor doesn't. So a deal that has an 8% preferred return only can produce 6%.
Okay. There's a 2% difference there.
So there's a 2% difference. That 2%, again, it accumulates, but it doesn't compound. And so that 2% has to be paid typically prior to any additional preferred return being paid out. And so it all stacks up before the sponsor, the GP, starts receiving their funds. So like, let's say you had that 2%, left over from the prior year. The first order of payments, again, this is all about just an order and priority of payments. The first order in a typical operating agreement is we got to pay that 2% back.
Okay.
All the unpaid preferred return is paid first. And then the next order of operations in the waterfall is now we're going to make our best attempts with free available cash flow to make the current preferred return or the current preferred return current. So now we've paid the 2. Now is there enough money to get all the way up to that 8%? And if it does, if you can make that 8% preferred return payment, then any cash that is available in excess has the option to be split between the investors and the sponsor, if that is how the operating agreement is structured. Again, this is another, just note,
Right.
read your operating agreement because preferred returns can be structured differently. And what happens after that preferred return hurdle is met varies wildly also. What happens like in our deals is if we're at an 8% preferred return, you're completely current, that then a split starts taking place and a return of capital begins. And we split cash flow 70-30.
Okay.
So 70% goes to the investors in the form of a return of capital. You're starting to getting some of your money back. 30% of any of that cash starts flowing to the sponsor or the GP.
So let me just get this straight. 8% preferred return, but the investment is only able to produce a 6% cash on cash return in year one. Let's just say it's a 5-year hold period. Each year, it's a 6% return. So there's that 2% delta or variance that would occur each year. I would carry that with me for as long as it takes for the general partner to, repay me or make that variance current.
Exactly.
Okay.
And sorry, go ahead.
What about a preferred return? And I guess why does a preferred return matter to a limited partner? Why would a limited partner care if it's a 4% preferred return versus an 8% preferred return?
Yeah, it's now it's preferred returns are relatively standard, but it's a component of the deal economics to align interests.
Okay.
And it prevents sponsors from starting to make money too early. I guess of like we want you to be a little hungrier. Especially when, as a limited partner, the idea that I've just given you a lot of money and on the first dollar, like we're going to start splitting it,
Yeah.
but like you don't have any money in the deal necessarily. Now, most deals, most operating agreements allow any dollars into the project to be treated the same. And so, a pari passu treatment. So whether you're a limited partner investor or you're a general partner, all of those dollars will receive that 8% preferred return treatment. They get treated the same. The difference is then that back end or the carried interest that the GP receives as compensation for putting the deal together. They're getting their 8% on the money they put in because, hey, our money is equal. Your money isn't any more value than my money.
Right.
You may be putting more of it in, but my dollars should also receive that same return.
Okay.
And so my dollars that I put in, your dollars that you put in, they're all going to receive an 8%. But then if I crush it and we get let's say we get an 11% preferred return, or whatever the number is, 70% of that is going to go to both me of our LP dollars, whether it's on the GP, I put my dollars in, I get my share of that 70, but then I also receive the 30% as well because I'm putting sweat equity in. I'm actually the active investor in managing the project and might be responsible for those outsized returns.
What would you say if I took the LP lens and I said that the preferred return is essentially, it's not a safety net by any means, but it's kind of a risk mitigation tool in regards to an underperforming deal. So if the sponsor walks away, is maybe a little bit negligent, or gets caught up in life and kind of forgets to manage this asset, forgets to manage this investment appropriately. Again, we've already nixed the word guaranteed because it's simply not a guarantee.
Yeah.
But it is a minimum return at which I must receive as the LP before the negligent sponsor can make any money.
Hey, before we start splitting it all up, especially if there's not that much money to split up.
Yeah.
Like
Okay.
let's say that you're the not great sponsor, and you're like, this is going to be a great deal. It's going to be a 3x. We're going to knock it out of the park, and it just is. It's a crap deal. And they can return. They barely can return capital. Or they can return. They can return your money, but there's like a little bit of money left over.
Yeah, $1 million.
There's $1 million left over. Now the sponsor may say, I've done all this work. I should be compensated for but it's like, no, that's not the deal.
That goes back to the LPs.
You didn't achieve what you said you're going to achieve. So this is the structure. So like just for my time, I've been in an illiquid asset. I've been waiting. I've been getting no return. I get the first 8% return. I want my money back, and I want at least 8% because that's like at or slightly below long-term average of like the stock market.
And in the example of there not being enough cash to really satisfy that 8%, you're at least able to get the first 2%.
Exactly. You can at least get a
so
piece of
that sponsor can't walk away and you get zero, and they say, well, look at all that time, effort, and energy I put in.
Exactly. Yeah, and it pushes the sponsor. Again, it aligns interest to say, no, I need to do better than 8%. I need to push it to 15 if I want to make any money.
As a sponsor or the GP, when you're formulating and putting together a deal and its economics, obviously there's a big math equation that's involved, but maybe you've got to go out and raise the capital. 8%, you said, is the industry standard today. How are you thinking about preferred return on a marketing side or the deal economic side? Why not make it 6%? And then potentially the GP's in the money a little bit sooner. Or if you want to raise, more capital easily, why not make it 9%? How do you differentiate yourselves between your competitors and what makes the most sense for the deal?
It's good. It's a really good question. I mean, when we were putting the deals together, I just view the deal through like an LP lens, and because if we can't show if we don't have a plan to produce good returns, like we're not also going to make any money on the GP side. So at first it's like, how do we not just show good returns to an LP, but like what's the plan and what's the economic structure to produce a good return? And then it goes through a process of, and also, do we make any money while we do it?
Right.
And because in the best deals, it's a win-win. It's like the LPs are making a lot of money, and then the GP, we're making some money too. This is great.
Right. Seems like there's a little sweet spot there.
Yeah. So, I say that as in like, so there's levers that go the other one way or the other that are beneficial to the GP, or levers that are beneficial to the LP. Higher preferred returns obviously beneficial to the LP, and so I could lower that down to 6. And a lot of the deals that we underwrite don't achieve 8% cash on cash, which one of the main differentiating factors, or one important lessons that is the most often confused, is preferred return with cash on cash return.
Mm-hmm.
A lot of LPs will say, well, it's an 8 pref, so I'm going to give 8%. And that's not necessarily true.
Mm-hmm.
It can be true. I hear a lot the mindset, or I've heard this said a lot. Oh, you'll get it eventually, and you typically will. That's certainly not guaranteed, though. Deals do go, not our deals usually, but like deals have failed, and people have gotten 0 and had to put more money in. But usually, if you structure multifamily deals the way we like to, like our strategy, typically like our worst case scenarios are like a high single digit IRR or really kind of a low double digit IRR. It's like we didn't execute right. It's not that people lose money, not that you can lose money, just to be clear, but it's like, all right, we messed up and now it's going to be a 9, 10, 11, 12 IRR. And so in that scenario, again, it's saying if we started splitting the profits right away, LPs are going to get like a 7 IRR and we're going to make money, and we totally just didn't deliver. So I guess back to your question on how I view preferred return, it's a component of deal economics of I want that even if we can't deliver the cash on cash in the first like year or two. And so it's accruing that balance when it gets paid when at a capital event, that's typically, obviously if the cash flow increases over the pref, you can start paying down that accrued preferred return. But often it requires a capital event to get all of that pref current.
Right.
And so that's when like it's not guaranteed, but like you do get it eventually. If you're patient, like then you're not getting the full 8%, but you get it down the road. That increases LP returns. And so like even though the cash flow may be below 8, a preferred return at 6 versus 8, the 8% preferred return is still going to be higher, even if the cash flow isn't sufficient, because you're essentially accruing a balance that gets paid at the end.
Okay. Makes a lot of sense. It's the way I'm thinking about it is, just in the LP lens, the preferred return is almost somewhat of like a baited hook in fishing. It's kind of an attractor. And so if I'm an LP and I see a 10% preferred return, and understand there's different positions in the capital stack that otherwise may earn that 10% preferred return. But if I see a high preferred return, obviously my ears are going to perk up and I'm going to wonder, well, how is the deal going to be able to afford this economics? It seems like maybe a less effective sponsor could post a higher preferred return. Run the deal into the ground and maybe not even meet that 10% preferred return.
Not necessarily, but they could. I mean, I've seen it where you use a higher preferred return to attract investors, regardless of whether you can actually hit that level.
Right.
And there's also deals that are structured. And this we talked about. We weren't going to go into preferred equity, but you can structure deals where essentially you get your preferred return, but then what you're splitting with the sponsor after that preferred return is much less than common equity.
Right.
In those positions, you're typically getting in a preferred position even before your common equity LPs. But it's a much smaller percentage of the overall equity than the common equity. So it's like, you're paying them 10%, but they're only making up 20% of
their share of the
30% of the equity. So it's actually a relatively small payment that's getting that 10%. But they're still in that preferred position.
Understood.
Yeah.
Let's wrap up the jargon bin. I'm going to read this because I thought it was great. The preferred return, it's an alignment tool between the LPs and the GPs, protecting the LP downside. It's delaying any kind of sponsor participation in profits. It's creating equal capital discipline. And I think it's a really good way to look at it. Do you have anything else you want to add on the preferred return jargon bin?
Yeah, the only other thing I want to add, the only thing we didn't mention is what the preferred return is calculated on.
Okay.
And so the preferred return is calculated on, again, read your operating agreement, but the preferred return is calculated based typically between the current capital account. Why that matters is, so a capital account is like you invest $100,000. Typically you have a capital account of $100,000. When the capital is returned, that capital account is reduced. And so if there's a return of capital, whether it's through part of the water flow, you're over the 8%, and so that's counted as return of capital, or if there's a refinance and you get some of your money back, your capital account is reduced. And so that 8% preferred return is calculated on is reduced as well if your capital account decreases. So let's say you you had $100,000, you're getting your 8% preferred return, so you get $8,000 a year. There's a refinance, 50% of capital is returned. Your capital account balance goes down to $50,000. You still receive an 8% preferred return, but it's based upon $50,000, not the 100. So now you're getting $4,000 of preferred return.
Got it.
So that's something that people also miss, and that's where we've talked about project cash on cash, and current cash on cash. Again, it's nuanced. It's something that's very common, but investors are like, I thought I was getting my pref, and sponsors are like, you are. It's
Current
just it's on a different capital balance, and that also means when your capital balance goes to zero, the preferred return goes away.
So, in the grand scheme of things, as a GP, you're really trying to reduce overall investor capital balance to try to get the GP into the money a little bit sooner. So if you can refinance, and maybe this is next week's jargon, is return of capital or return on capital, because that makes a large difference in the reduction of the capital balance.
100%.
Interesting.
Yeah.
That'll wrap it up for the jargon, Ben.
That's good. Hey, if you have any questions about preferred return or any suggestions that you'd like us to tackle on the jargon bin, whether they're kind of novice, intermediary, I can't say any words today, intermediate or advanced, let us know. We'd love to jump into it. Or we just wanted to get our take on a concept, whether it's a term or something different. And while you're here, make sure you subscribe to Great Capital YouTube channel and follow us. Let's get into this next piece. Yardi Matrix National Multifamily Report for January 2026. It looks like, Griffin, am I reading this right? We've got a positive rent growth print in January.
Right.
My God, what's going on?
It might be small, but it's positive.
Hey, size doesn't always matter.
Scroll down just a little bit, just to the first sentence of that new year, new multifamily renter performance paragraph. The rents rebound. I saw that and I got kind of excited.
The rents rebound.
At the end of January, national multifamily average advertised asking rents rebounded. Now, I will say it's asking rents.
Yeah, I love it. Yeah, it's just like the broker speak. Either they're asking for it, or the property's growing rents by 15%. It's like, tell me about that trade out. It's like, well, they had a unit that there was someone that had been living in there for 20 years and never raised the rents, and then they raised the rents below everyone else's market, and it's technically a 15% trade out. It's like, that doesn't count.
Right. It does not count. I will let you say what you want to say about the Yardi Matrix report. The reason that I included this into the newsletter in this past week was really because I liked the data visualization just down the 10 markets for year-over-year rent growth. There's 4 categories up top of the blue little buttons. You can actually toggle those and look. Indianapolis, number 4 for forecasted rent growth across the year. I think that's exciting to see. But if you look at rent growth and forecasted rent growth, the Midwest is omnipresent throughout both of these lists, and it's exciting to see because it is our expertise and our specialty. It's where we invest, and it's where our investors are also placing their capital.
It's where everyone wants to be. What I think it's important to note, this is, for Midwest focused investors, this is all good news. Indianapolis, Kansas City, Columbus, Detroit, all taking the 4, 5, 6, 7 spot. Midwest really dominating. You've got coastal markets like DC, Boston, New Jersey. They're making the top spot. Many of these are kind of recovery stories or not, just lower, much more mature markets. Sure. But I think, again, the top forecasted rent growth is 2%. Again, this is
a slow year.
It's going to be a slow year, and I think that's fine. That's where I think that there's opportunity in the acquisition space because everyone now understands the slow growth this year, and it's not, again, like we're not seeing massive negative rent growth across the nation. Things are relatively balanced, but it's not enough growth when you're trying to pencil an acquisition because, again, this is where we're not scratching my head because I get it, but when you start learning about commercial real estate, one of the first things you learn about cap rates, and go back and watch the great report jargon episode on cap rates. But you learn that the properties they don't trade off of comps necessarily. They sort of do, but it's not like a single family home. It's not just because that single family home traded for that and that single family home traded for that price and that price and that price, the average square footage. These are investment income products. They're traded based upon the income they produced, and then also to an extent, and this is where the crux is, your forecasted revenue growth and really rent growth and income growth. Maybe how much will that income grow over time? If you think that it's going to grow by a lot, well, maybe you can pay a little bit more for it because you'll grow into it, and that stabilized yield is more of what you're attracted to. But again, I learned, buy on actuals, pay for what that thing is actually producing. That's a good deal.
Yeah.
Don't just buy on speculation. The nuance is you have to incorporate speculation a little bit, because the whole reason why you're buying something is you're probably going to do it better, and you're hoping you're going to maybe raise rents. But how are you going to do that? And it's really clear that there's an opportunity to raise rents or move expenses. Why not factor that in to your acquisition strategy? I can pay a little bit more because he's literally burning dollars.
Yeah.
And I just have to stop burning the money, and I'll make more money than he will.
Correct. Yeah. Correct.
But in this case, and often what we see is it's not being traded on. So on actually the income, it's what the owners thought the income might have been a couple of years ago, and just the price that stuck in the owner's head that they want to get, they would like to get to hit their return metrics. Because so when we see growth like this, when you go to model and forecast that growth, it limits how aggressive you can be.
Correct. Yeah.
Because if you put in 5% rent growth, you really have to have some data to point to justify it.
Well, and the seller's looking, backwards, almost saying, well, look, I grew rents 5% last year. I grew rents, over the last 5 years, and an average of 5.5%, 6%. Whatever it might be, they're looking backwards and saying, look at all the growth that we've achieved. You can do the same moving forward. But then we're looking at 2%, saying, well, it's maybe not going to be that.
Yeah, saying that you achieved $200 rent premium in 2022
doesn't do us any good.
Doesn't do us. It's like there was a feeding frenzy. Everything was 100% occupied, and I'm sure you did find someone to just take it because they needed a place to stay.
Yeah,
it's a different world. We just delivered more. We've delivered, 1.8 million units since then. We've around 1 million units in 2020. Or more than that, almost 2 million units since then. So what are you talking about?
Right.
It's a different world.
Right. Talking about deliveries, if you scroll down just a little bit, there's some really interesting, or I guess attractive absorption numbers that came through in regards to 2025. Watching, was it 590,000 deliveries?
590 last year. I think the million was in 2024. I think it was like 900 some thousand.
I wanted to bring this up, and I think it's interesting. We're talking just about the supply, kind of pullback or the cliff, that we're already in, and really across 26 and potentially into 27, we're going to see, obviously reduced supply compared to peak and compared to the past 2 to 3 years. It seems like the demand is still there, and with supply coming down, obviously, like you said, 26 may be a slow growth year. It's really tough to look into forward-looking years in 27 and 28, but with the story of absorption and the pullback of supply, you can kind of start to imagine and envision accelerated rent growth maybe in the next 3 years.
Yeah, but it's also how I think, over the next couple of years, but even just the way, again, like Yardi is like writing this, they're turning into a more positive story than it may be.
They got what are the rose-colored glasses on?
Well, just because they're just saying like absorption was really high, and it's because absorption is high because supply was really high. There were a lot of deliveries, so like they didn't get absorbed, but they're
still
deliveries outpaced absorption. That it would have been the real story would have been absorption outpaced deliveries.
Right. There's still 70,000 units here that are
that
means
to be absorbed. Vacancy goes up.
Yeah, and that's also included in this article is that the vacancy is ticked up nationally. So I mean, it's the math equation is all making sense.
But it's like they say it as ranking 2025 as the third highest absorption of the past decade. That is true. It doesn't really matter that much. And but it's like a positive indicator of the environment. And in a way it is. I mean, again, we could be looking at 590,000 deliveries and 250,000 absorption.
It could be worse.
It could be. And I think that is its relative strength. Like, again, the supply is outpacing demand, but the demand is surprisingly keeping up with it. It's lagging behind a little bit, but it's at least kind of like staying pace.
Right.
And it's not just being left in the dust. And so that's where we're not seeing the collapse. But it's also not enough to justify some of the prices we're seeing in the market.
Would be nice to see some price discovery. And just, I mean, we talk about the bid-ask gap all the time. Just would like to be able to see that kind of compress a little bit, get a little bit closer together. Thoughts on that? You're just up in Fort Wayne. You're talking about the pricing not being, what you'd like to see. What's the product of that? Just past year's growth being substantial.
The product of why price?
Yeah. What's the deal? Why do these sellers?
Well, it's been like this. It's been like it's nothing new.
Yeah.
It's been like this since 2023 ish. I mean, sellers have their prices anchored at a point in the past, and even if they're understanding that we're not in the past, we're in the present.
Yeah.
It takes a lot to move off of that, and obviously there's investors that they've been probably telling that like, "Yay, we're going to be able to still achieve X, Y, and Z, and all's fine. Don't worry about it." And a lot of people no one wants to be told they're going to make less money or no money. And so there's just like a refusal to believe. Then there's also an anchoring strategy from that sellers and brokers use effectively and appropriately of. Hey, look, like if this is what you need, we got to start even further out just to try to see who's serious and like just put it out there and see who's hungry.
Right. Kind of weeding out the.
Yeah. And also they don't want to leave. There's been enough times that brokers have seen like 1031 exchange money come in.
Yeah.
That needs to place
capital.
Yeah, they got to find a home, and so like, and they're sometimes they should just look at a normal deal, but sometimes they can be so driven by tax savings that they're not even looking at the deal. Mm-hmm. So like I got to buy $50 million deal.
Yeah, it doesn't matter where
something comes on the market, and it probably should be like a $45 million deal, but they'll be like, I'll take it at 50.
Right.
And so like we're here trying to like try to find where the market is and buy at a discount and achieve good returns, and they're just like, we'll take it. And that's not the broker. That's not the seller. I mean, that's technically where the market is. Mm-hmm. And it's that this environment is partially due to lower volumes. And the volumes have been picking up.
Right.
But there's enough capital. And there's enough capital to make a bid at the high prices. It's limited, but there's enough given the current inventory. There is significant capital with bids in just below, call it
right
7 to 15% below where those are trading.
Yeah.
Like the active like bid orders, if they're such there's a huge pile of capital ready to go, which we've talked about this floor in multifamily, that even loan maturities, all the banks start calling all the loans. Not if liquidity gets pulled out, that people don't run to the sidelines and things can't happen quick because people get scared and things move fast. But at least today, there's so much capital. And even in that environment, there's so much capital that's been like awaiting for some kind of, extreme situation that just never come to fruition. Mm-hmm. Do people get cold feet when that happens? Yeah. Many will. But there's still enough that like this is what we were born for. This is what we're here to do. Mm-hmm. This is our time. Mm-hmm. That I still think that some sort of effective floor is in place. But I don't know. What do you think?
Well, I've got an anecdotal story on the single family housing market that's similar to this. Kristen and I, my wife, looking to move out of our home, thinking about renting, you've been, you're going to have to give us an update. Listeners at the airport want to know what your housing situation is. We've toured or viewed a couple homes, single family homes, to buy. Are you guys not going to renovate? You're going to buy. We're going to renovate our house. You're going to buy it. We're one also. So the way that I'm viewing,
you told me about this strategy. This is very complicated.
The way that I'm viewing the rental scenario is that where we want to live, and again, we've maybe have too expensive of taste and needs that jack the price up. But we want to rent a single family home to have our own yard, no shared walls. We're looking at $3,500 a month to rent a single family home in the neighborhood that we want to be in. Now we can make some concessions and move elsewhere, but that's essentially from $40,000 to $50,000 a year to live in a house. Well, why
I'm
not?
so excited to talk you out of doing
Right.
what you're thinking about doing.
Why don't we just take the 50,000, go buy a house with it, and live in the house, operate it for the year, and then it's not going to be a nice house.
Can't tell you why not to do that.
And we're going to rent it out. And then once we get financially stable again after our home renovation, we're going to renovate that house and then we're going to sell it. But in this offer, and this is maybe like a little window in, we gave the seller exactly what they asked for. We gave them, I mean, I talked to the listing broker and I said, who's your ideal buyer? Tell me to me right now.
Yeah.
It's face to face. He said, we want as much money as we can get. We want it quickly, and we want to jump through as little hoops as we possibly can.
Sure.
So we gave him that. We gave him exactly what he asked for. And our offer was not selected for the house, but I got a message from the broker that said, I'm really sorry. You guys easily had the best offer. It was the most streamlined, gave us exactly the number of dollar bills we were looking for, and you didn't make us jump through hoops, and we were going to close in like 2 weeks. The story of this house is that it was an old elderly lady who had passed. She had 4 kids, and they were looking to sell the house and split up the funds. And so somebody came in with a little bit over asking. I don't know how much just yet. I can't wait to find out because, we could have maybe gotten there. And they chose that offer. But that offer has all these hoops that the buyer wants to jump through with a bunch of inspections, and maybe the seller has to pay for repairs and all these things.
Price or terms. Pick one. You can't have both.
Yep. And so I was bummed, but we got outbid by somebody that I think maybe wanted to live in the house long term and start a family and do that kind of thing, which makes a lot of sense. But I can't wait for your rebuttal here.
Well, I'm just so okay. Transaction costs. I don't know what price range you're looking at.
Right, it's $400,000.
Okay.
I'm happy to walk through this with you.
So you're looking minimum. You're looking at least $25,000 to $30,000 in just transaction costs on the sale.
Right.
So and so then you have any mechanical issues, you have any roof issues.
Yep.
You know how quickly.
Oh yeah, that
$10,000. So you're at that $50,000 so quickly, and it could be more than $50,000.
Yep. Could be.
And then what's your time worth of buying a house, selling a house, renting a house?
Yeah.
That's just and then again, I don't know your whole situation, but like use of cash, it's a lot of liquidity to tie up in liability liability, which is a single family home.
Right.
What if your rehab goes over?
Well, so that's another story about our house that we're doing right now. Is we got drawings and renderings back from our architect. It is like 1.5, maybe 2 times our budget. So we're having to scale that back. Our timeline's delayed. So now we got plenty of time to find a house.
You're going to scale it back, and then it's still going to go 1.5 times. So like whatever your 1.5, add another half.
Yesterday we got found out we didn't get the house yesterday. We found out that our timeline got pushed. We found out that we were way over budget yesterday. It was a bad news day.
Sorry for
That's
that.
Okay.
But some things are meant to happen, and I don't intend to rain on your parade.
No. My wife is very much if it's meant to be, it will be. We're not out of the renting thing. We just haven't been able to like really find a place that is going to like make us feel really, really, really good. So, but the house was. I am
going to again shared walls. I understand. Beggars can't. You can't have it all.
Yeah.
And salon at the crossing. Which is like down the street from where you currently live.
Yep.
It's
like
closer to the office.
It is.
I would live there in a heartbeat if I sold my house.
Yep.
And if I wanted to like downsize, I'd be there in a second. So it's not a bad place to be. But I get the shared walls.
Mm-hmm.
But you're not going to be there
you
forever.
You get a pool, a weight room. Yeah. Oh yeah. It's going to be maybe 12 months. Well.
Bring Kristen in here. I can talk. I
can
sit down with you guys and we can talk.
That's the client you need to close.
I figured. Yeah, it always is.
Fine. She works from home. We got a dog. She wants to have some space and some privacy and access to the ground, and she's got these check boxes.
Yeah, I want an F-22 Raptor.
Well, let's go get you one.
Yeah, exactly. Some things we want, some things we can't have.
Right.
And but you guys are going to make great decisions whether you buy a house. It's all going to be good. Again,
best part about Solana, it's always there.
it is always there.
We apparently have plenty of time.
And I guess the renting, it's like you kind of know what your max loss is.
Yeah,
And so it's like
exactly.
you're buying you can quantify what your
Safety net.
downside is.
For sure.
Versus again, like
Now this house specifically was 2 minutes from our house.
Yeah.
It was on 0.8 acres
Yeah.
in the middle of Carmel, Indiana.
Might not be bad.
Listed for 400. I think the earth alone was worth 500. I think if you knocked that house down and you just sold the lot, you could get $500,000 for it.
Maybe. Yeah, I could see that. Unless there's something wrong with it. I don't know.
There could be, who knows.
Yeah, the price right.
We were it was being sold as is. We did a little as is addendum. So
yeah.
we're gonna have an inspection, but not hold them accountable for any not hold them accountable financially for any remedies.
You may have been buying just the land.
May have been behind. The house was actually really nice. I would show you the listing here, but we're in the middle of a podcast, so.
This is a real estate podcast. I think people want to know what's going on with Griffin.
Should we jump into the Arbor report, or should we skip that? It's about rent growth. Again, the Midwest is just leading the charge. This is specifically about February rent growth.
Yeah. We can go through it quickly. Top U.S. multifamily rent growth market, slightly different from the Yardi Matrix report. San Jose.
Where's the Sunbelt in here?
What we got Alabama and
Yeah.
Georgia and Florida.
Yeah.
Georgia and Florida's in there, but specifically Orlando and Florida, and we've got Atlanta, which is that's. Atlanta has gone through a tough time. Again, my question about Atlanta is: are you actually collecting any of your rent? The collections and the collections and bad debt story in Atlanta, and the ability to collect, the inability to evict, and the overhang of the so-called eviction moratorium. Now that creates opportunity, and so they're finally picking it up. And I know some people who bought in Atlanta, and probably makes a lot of sense. But it's coming off a rough patch.
All right. It's the common city that I've seen across a lot of the rent growth forecasts and reports is Minneapolis, and the current climate and
do you think it's an opportunity? Because you know what, when I told you at NMHC, Minneapolis was like on the
buzzword.
It was
No?
I wouldn't say that. Well, it's not from people who actually buy or own the real estate, but from the economists.
Oh,
the data is talking about, hey, Minneapolis. Now, obviously, there's some political risks, and the data isn't taking in every factor into account.
Okay.
But
yeah, sure.
It probably is to say that I think that people are probably painting Minneapolis as maybe really worse as it really is. And again, painting with a very broad brush. And I know people from Minneapolis, investors in Minneapolis, and they're like, yeah, some of the politics is really frustrating and annoying, but it's not like San Francisco.
No.
I mean, it's not like Indiana, but it's not that bad.
Right. I think the story that I've heard in Minneapolis from friends that family live there, they live there, they've visited there in the last, year and a half. There's little pockets of greatness and great opportunity. Yeah. And there's little pockets of stuff that maybe you don't want any business.
I think most of it's fine. I think, there's pockets of both, and probably more good than bad.
It is a common theme on all of these rent growth reports and forecasts is Minneapolis. And it's interesting. Some of them say Minneapolis, some of them will say Minneapolis, St. Paul, some will say Twin Cities, but it's curious if this one is only Minneapolis and St. Paul is being excluded. It would be interesting to know.
Yeah, it's number 2. A lot of Midwest markets, again, Minneapolis, Milwaukee, Cincinnati, Cleveland, Kansas City, and St. Louis. That's what it's 1, 2, 3, 4, 5, 6 out of 10. Midwest is punching above its weight once again. And again, I don't think that story is going to change anytime soon. The Sunbelt will have a recovery eventually. It's market by market, but for markets like Austin, it's going to be maybe 2 or 3 years. And just again, this the idea of your compounding growth year after year. And it's amazing. I'm just thinking back. I don't know why. I mean, a 2-bedroom apartment, just $850 was just like, that's what a 2-bedroom apartment rented for. At least when I was starting getting into the business, that just seemed like very standard kind of that range, maybe 800. You can maybe buy a one bedroom for, 700, 750. And, now in Cleveland, effective rent is, 1,200 a unit. It's just, we've had a little bit of inflation for the last
Right.
couple of years. The value of our dollars just
We
have
love to talk about
eroded.
the affordability of the Midwest, and it's very visible here. You take a look at San Jose, number one, the average rent's over $3,000.
I mean, look at this concentration. I mean, honestly, it's just like we're missing Indiana.
Right.
Indianapolis was on the last list. It missed this list.
San Francisco over $3,000. Average effective rent. Northern New Jersey, $2,500 average effective rent. Long Island, 2,800, almost 29. Then you take a look at the Midwest. Cincinnati is 1,200. Cleveland 1,200. So the 850 may be a thing of the past, but
Oh yeah,
the $1,200 rent's looking very, very affordable.
yeah. St. Louis, 1175.
Right. Yeah.
Seems like a good place to be. Where would you like to take us next, Griffin? You want to go to CPI and
Yeah,
housing?
because I'm really looking forward to the way that you're going to approach the combination of the Zillow article alongside, I think it was a Globe Street article that basically
Yeah, says what we've been
spoke for you.
Well, I'm not. We have been talking about it on this show. Matt and I talked about it a lot since we're always interested in inflation and interest
Yeah.
rates and all of that. But I mean, for the first half of my career, I mean, interest rates were kind of relatively flat. It wasn't. It was predictable. It was like a little moving in here and there, but it wasn't that much of a story. There was no inflation. There wasn't anything to talk about, so it's not something we need to worry too much about. So CPI is, the many people's primary gauge of inflation. It's not the only gauge, but it's what most people look at. It's Consumer Price Index, and shelter makes up 33% of the index, the shelter component itself. And a large component of shelter is owner's equivalent of rent, which is not necessarily what everyone is paying, but it's actually like a survey that people like call and say, hey, if you were to rent your house out to someone, what would you take for it?
Right.
And this was Milton Friedman helped kind of put OER. He was one of the people that helped put OER together, back in the 70s or 80s. And it's just the question is, does it do a great job of really capturing the cost of housing? And because what it's trying to do is it's not trying to track asset prices. It's trying to track rentals and real estate as a service proxy. We can almost think of it as like real estate as a service.
Okay.
And so none of that has to mean anything other than just what we know today is what OER, owner's equivalent of rent, and shelter, its growth rate is vastly different from where rental rates are growing in real time. And there used to be, I say used to be, some people still say there is, this idea that, just OER rents, there's just a lag. It's trying to not just take into market rents, which again, like we talked about, asking rents, who's actually bid on it, who's actually paying that price. It could be one person. That's not where all the rents are. So the idea that like, look, there's all kind of what's really, we're solving for the effective rent. What is everyone actually paying? But it's not like you go to the gas station. You go to the gas station, maybe once a week. If you still drive a car that takes gas, and so like that's like they can track that price and it makes sense because that price is resetting. They're using it at a pretty high frequency basis. Where rents are, typically resetting on once a year, but what someone might have signed a lease for in January and later on in the year, it may or may not be the same. And again, there's a big difference between what the market is asking and someone who signed a lease maybe years ago and hasn't had much rent growth. So it's trying to take all that all into account. And again, the methodology only matters so much as to, does it give us a good proxy for rent growth? And the answer is no, because it's been so mismatched. When rents were growing like gangbusters back in 2021, 2022, it was relatively flat. And then when rents went negative, rents kept growing for years. We had negative rent growth in 2023 and basically flat in 2024 and then negative again in 2025. And see, OER and shelter has never gone negative. OER has never once gone negative, even though nationally we've put up multiple years of negative rent growth. And certainly rent growth that's been well below 2%.
Yeah.
And then CPI is saying, that it's growing by 3%. And people are like, it's coming down. See, shelter inflation is coming down to 3%. And OER is coming down to 3.3%, but it has nothing to do with what people are actually paying for apartments in real estate. And where all this folds into the broader macroeconomic picture is that these interest rate decisions are based upon the rate of inflation. Now, the FOMC's primary gauge of inflation is PCE, the producer price, or PPI, the producer's price index. So PCE, all the different terms. They look at PCE, which is calculated slightly differently, but these decisions are being made off of this index. And the point that we've been making for years is that the math doesn't make any sense. And so we're saying that we have all this inflation because rents are high. We're seeing it every day, even though we're in the Midwest and rents are growing more than other places. But we do this every day. We're tracking the data. We've got research reports we're putting out. This is what we do. And we're the rents have been negative or flat the last 3 years. But you say they've been growing 3+% for the last 3 or 4 years. That's not true. And then we're going to say we're going to make an interest rate decision, which is essentially fixing the price of money based upon data that makes no sense.
Right. I love the second sentence of this article that Erica Morphy wrote.
We're getting to the article.
Multifamily owners hear that number and wonder what planet the statisticians are living on.
Is that what I just described?
I love that so much.
Yeah.
What planet are you guys living on?
Yeah.
You have these totally opposite headlines of negative rent growth across the nation. National rent growth is negative, and then you see CPI rising, and they will blame rent growth for the inflation. It just does not align. It's incongruent.
It's incongruent.
But I just love that sentence. I thought it was great. I think if you're looking for more specifics, the Zillow article, the CPI shelter forecast for January of 2026, which I now think may be a bit outdated as we're into the month of February. It does take a look at the OER versus the CPI for rent of a primary residence, and they're both growing year over year at rates of 3.26 versus 2.84 respectively. And then you take a look at national rent growth, across 2025, and it was flat if not negative.
Yeah.
And so it just doesn't align. There's no congruence there.
So let me ask you this Griffin, if we're coming in just keeping OER just base case. I mean, we're below 3% inflation. We're not at 2%, but we're below between 2 and 3, with assuming that OER is accurate. Where do we think inflation is? Right. If rents are actually low, if it's 30%.
Yeah, we talked about this, months ago, about how housing is latent, will show up in a latent fashion in regards to inflation. So,
but I'm not talking about when it's going to show up in the numbers.
Okay.
No, I'm talking about
where do we think actually inflation is
because
today?
you'd think that the Federal Reserve isn't the number on the paper says this, and so for the number on the paper, we need another number on the paper. At some point, it has to impact the real economy.
Sure.
And interest rates do. I mean, again, they're fixing the price of money, and they're using data that is not. I mean, it's like when I'm putting together, a tool. You're putting together an AI tool, and it's giving you. It's not exactly accurate. It's kind of close. It's
right.
Maybe it's directionally correct, which is maybe what they're where they're going for, and they want it to be lagged. They want it to be smoothed out, which is one of the reasons we want to smooth it out. But it's we should and this is the question that people are asking: is there a better method? To gauge inflation, or is there just a better method to look at shelter? We're looking at methodologies that were developed 50 plus years ago.
Yeah,
a few things there are a few things that have changed, and we have so much better and richer data to go off of. With all this, we talk about all the private. We have all the private data all the time. We produce private market data.
Yeah.
I was having a conversation with brokers today that, they have data that goes back, decades. It's like, why don't we look at like the real data to make informed decisions?
Yeah. I listened to a really great take. I forget who it was, but they're discussing Kevin Warsh, the Fed chair nomination
Yeah.
that will hopefully take his seat in May, I believe. They were just discussing that he can bring a new aged approach and try to develop a team around him or at the Fed that is actually building out data dashboards that are grabbing data in real time rather than making these current decisions that are affecting tomorrow based on the data from 30 days ago.
Yeah.
And I thought that was an interesting take, just the implementation of new age technologies to grab real-time live data and put it right in front of the Fed. So when they are making their decisions, it's on yesterday's data and not last month's data.
Yeah. I mean, they were using some of the private market data during COVID because of all the, the public sources just shut down.
Yeah.
So they'll look at it. And what you hear from the Federal Reserve, the FOMC, is they're like, yeah, we see all that. It's very much like, we're very well aware.
Yeah.
We know about all of that.
Yeah.
And it's true. I mean, I forget which Fed district did it, but they've done research report papers on this concept of OAR and like, should we replace it? But like, it's like somebody over at, the Atlanta Fed
who makes
on a
that
project
decision.
and it's like, this is a fun little research paper, but then it trickles up and we're not changing that.
Right. And then like who gets the ultimate say of like, yeah, you're right, we should move on from that.
Just how disruptive to markets it could be. I mean, remember in the government shutdown when we stopped getting BLS data, we stopped getting CPI. I mean, everyone was freaking out. Now, we all survived. We got through it. And what happened? Well, we started looking at the ADP report. We started looking at some of these other, private trackers. And, this comes all the way back to conversations earlier this year of, when there was controversy with the BLS, the Bureau of Labor Statistics. Remember, Trump fired the head of the BLS because he didn't like the CPI number. And while it's like, that also did not look good.
No.
And probably not handled the right way. But like, does the BLS produce like, good data? Not necessarily either. And are their methodologies good? Do they need to do better? Probably. And then again, this is maybe sounding extreme, but like they provide a great service. I use the BLS data, census data. Yeah. I'm glad that there's like an organization that's collecting that information. We're all paying for that collection. Are there better methods to do it? And when I think about like government services, and again, it doesn't really bother me that there's somewhere in the government's like keeping stats. That's fine. It's just like we're all relying on it. We're making the decisions, and I guess the price of money is being fixed by
decisions. Yeah.
And I'm like, if the BLS went away, like as it kind of did, like the data would be there, and the demand for data is there, and we have the tools to be able to probably come up with like better methodologies to quantify where we are in the economy. So again, I'm not talking about closing down the BLS or anything.
Phase some new data in over a course of several years.
I'm just saying, if if you're not producing quality outputs, then what is the point of you existing and sending you taxpayer dollars?
Right.
And
I think it's a good argument.
And I think we should let's make it better.
Yeah.
But like, this is gonna be an interesting story. I mean, inflation, shelter's a huge component. We're gonna see shelter inflation continue to decline because again, if we're assuming there is a lag, we've had slow growth. That means we're going to theoretically have quite a long period where there's going to be slow growth from a rental standpoint. And then does that allow the Fed funds rate to come down? Especially if unemployment or employment decreases, unemployment goes up related to AI, then the economy is slowing down a little bit. But then we're in a precarious position because maybe we have this huge productivity boom that's going to come that absolutely will come from AI. So we're in this situation where, maybe we're seeing like really strong GDP growth but higher unemployment. And in that situation, you would want to typically, lower rates to increase employment because we need some like real economy stuff, people putting shovels into the ground, people buying stuff, building things that still require people, incentivize the economy that way. And maybe it doesn't impact, AI and just the deflationary. And this is Kevin Warsh's, I believe his part of his thesis, and I agree with it, is that technology is incredibly deflationary, and we're underestimating the deflationary impacts of AI.
Sure.
I mean, we're seeing it in the software industry right now.
Prices are going
It's
way
all
down.
deflationary.
Yeah.
I'm more concerned about deflationary pressure than inflation right now. Now, are we still seeing some inflation across like our sites, like a little bit here and there? We're pretty much caught up and figured it out. I'm more worried about deflation. What I think helps us in multifamily, again, is just supply is slowing down. If we kept building and building and building, then we really could see some
point. Yeah.
significant deflation. And that is the killer to multifamily, is a deflationary environment, not the other way around.
Deflationary environment with just plentiful supply. Then you're really in trouble.
The price is going down. Yeah. Now, the good thing about the deflationary environment is theoretically, the value of your dollars may be going up.
Sure.
Your purchasing power increases.
Yeah.
So that's
It doesn't change our debt payment services though. We still owe.
No, and that's what we need inflation to. We need to inflate the debt away, because the dollar balance stays the same. But if we have our dollars are worth less, or if we have less dollars to pay down the debt service, we can't grow out of it. It becomes a problem, and that's where the government is incentivized to have some inflation to inflate that debt away, but they can't have too much or get over their skis.
Interesting. The last piece that we have, I thought it was interesting. The Federal Reserve Vice Chair for Supervision, Michelle Bowman, gave a speech about how she is looking forward to the implementation or the introduction of two forward-looking policies that are looking or aiming to put mortgage debt origination back into the banks.
Yeah.
Curious if you dove into this, what your thoughts are, and how it might impact the multifamily acquisitions.
I don't think it will have a big impact. I think they're mostly talking about single family homes. I think that they want banks for that to be a primary business for them. And it's been challenging. There's a lot of new lenders, a lot of new private credit, just a lot more competition, kind of the traditional banking sector. But making home loans, I think, is a key component of the banking system in the United States.
Yep.
And so I think that they want to see that. The Federal Reserve is the banking system of the United States. All of the banks in the United States are chartered members of the Federal Reserve. They remember all the banks gave all their gold to the Federal Reserve took it all. They took all the gold from all the banks, and so they said, "But it's going to be our gold.
Yeah.
All of your gold is going to be our gold of the Federal Reserve. We're going to take all of your gold, and so it's all of ours now. And you're going to be a member of you have a Federal Reserve chart. I'm not a banker. I'm not an expert on how banks work, but so they want to bolster banks, and they don't want to lose control of that industry and kind of the bedrock of their collateral, what they lend on. So
I had no idea. There's some stats that are included in I believe, an article that I associated with the speech notes within the newsletter. Just some stats. Bank mortgage origination share in 2020 or 2008 was 60%. In 2023 was 35%. Bank mortgage servicing share in 2008 was 95%. In 2023 was 45%. So following the great financial crisis, they really kind of removed single family or real estate debt from their books.
Yeah, I think the banks got in trouble, but then also again, there's Rocket Mortgage, and there's all these other sources, lenders,
third-party servicers or
originators. Exactly. Yeah.
It's a pretty staggering kind of drawback based on where they were in 2008, and then obviously the great financial crisis spurred them away, and other vendors or originators stepped in.
Yeah, her closing thoughts, I just kind of think sums it up. By creating a resilient mortgage market that includes robust participation from all financial institutions, we can deliver affordable credit and high-quality servicing to borrowers regardless of economic conditions. Strengthening bank participation in these activities does not threaten the safety and soundness of the banking system. These goals are consistent. So, they're just saying the loans are going to come from a lot of different places.
Yeah.
It's all good, but banks need
we got to get the banks back in the game.
They need to be the bedrock because just the way the banks are regulated is vastly differently from these other originators. Yeah. So I don't think it impacts multifamily, that much. I think it is interesting. But a lot of, I think there's going to be a lot of changes at the Federal Reserve. I think with Kevin Warsh, I think it'll be interesting. He is significantly young. He's relatively young, a Fed chairman. Surprisingly, a lot of experience. Again, he was a Fed governor in his 30s.
Right, like the youngest Fed governor in history, or recent history, modern history.
Well, I mean, the Federal Reserve's only been around since 1913. So again, it's kind of sort of a new thing. It's not like exactly a new thing.
Yeah, I just started 1923, the show on Paramount Plus, no free ads. I just lost my grandfather this past summer. He was 93. So I was like, man, I was trying to calculate in my brain, what year he was born. It was, I think, 1933. But I was thinking to myself, man, this guy was born when there was covered wagons and horses and all that. But, the Fed, same thing, covered wagons, horses, the introduction of the automobile. It's really not that long ago, but the progress that we've been able to make as a species, as a planet.
No, there were Civil War veterans in parades in that era.
Right.
And there's pictures of them. Yeah.
I just turned the show on and I'm like, holy cow, this is like 1923. This is crazy. Now they're out.
That's a good one. That's good.
Montana, and maybe the progress hadn't quite gotten there as quick as it did in the East Coast. But I was still very like, wow, this is crazy. I paid attention to history, but this kind of re-jogged my memory.
It's a good show. Yeah. Private credit has changed a lot. Again, there's a lot of different players, and that's changed the way the Federal Reserve thinks about it. But the Federal Reserve has to be thinking through, how they are going to, look at some of these, I think, structural changes. Whether it's, how do we calculate things like OER and CPI, whether they want to move towards a central bank digital currency, which I think Kevin Warsh basically does not want to do, which I think is a good thing. I don't think we want the Federal Reserve to be being able to pull money from our accounts, or having access. We just don't need them to do that. That's fine. Someone else can do that. There's plenty of those. We don't need the Federal Reserve doing anything else.
Right.
How they're going to incorporate AI, so from a data perspective,
sure,
is going to be vastly integrated. They have all of the data. I've been having a lot of fun with Claude over the last week or so, and I'm pulling from all the Fred, the St. Louis Fred APIs. It's a great resource. As much as I complain about the government data, it is out there now. Like the BLS, the BLS, like update your website.
Yeah, since I've been doing the newsletter and grabbing some of the data from the core data prints, it's like, holy cow, this is brutal.
I'll vibe code them a new website for
overnight.
Yeah, and instead of the $25 million they've earmarked to build it, I'll do it for them for $15 million.
That sounds like a good price.
Save the taxpayers some money.
That sounds like a great price.
Go buy a piece of real estate.
I think you should.
It's a win-win.
You should present a little proposal,
and we'll get you we'll get you the single family home.
That sounds great. Throw that in there.
Throw that in there. I think we can squeeze it in
really nice
once after hey, at night of vibe coding, we'll take it. What's your feeling on going forward, Griffin? Is this going to be? Are things going to break? Are deals going to happen this year? Is it going to be Groundhog Day, more of the same? Of like, it's just you have to work 10 times harder to find one. Are we going to have? Is there going to be blood in the street? I mean, let's close this out with some like hard. What? I mean, you're thinking about buying a house, so it can't be that bad.
I am. I think that patience pays off. I think people that are really looking in the deep rough will be rewarded. I think the people that are looking for the easy way out or looking to just stumble on a deal are going to be looking for a long time.
Yeah.
No stone left unturned. I'm not a pessimist. My wife calls me a realist. I like to think I'm an optimist. So I would like to think that if we keep operating the way we're going to operate, we're going to achieve our goals. The 3 goals that we've discussed here internally. It's only a matter of time before I think things start to turn around in a buyer's favor. So I'd like to imagine just being patient, but it is getting quite frustrating. You mentioned total deal volume that we underwrote across 25, but only closed on one project. I'm sure there's firms out there that looked at the same amount of deals, if not more, and closed on 0 projects.
True.
Or there's
Yeah.
groups out there that closed on 10 projects and they're maybe in a little bit of distress or panic. Could be potentially or not. But I would like to think that if we keep turning over each stone and in the multifamily space, if people just keep doing the right things, they'll be rewarded.
Kind of have to trust the process.
That's kind of what I'm getting to. That's a more blunt, very direct way of saying it. Yeah. Nice job.
I mean, well, it's. I mean, you remember when we're in the middle of a capital raise,
Yeah.
whether it's flats, just think flats recently. I mean, there were how many times did I say to you and Blake, them like we kind of have to trust the process a little bit.
Have to.
Because there are times when
the bait was in the water.
The bait's in the water. We're doing the things that we need to do, and and what I'm talking about is when you're raising money for a multifamily deal. We only have a limited amount of time because we don't typically have all of the funds pre-raised. We're always having conversations with investors. We know who we think wants to go, and we have potential commitments of typically hundreds of millions of dollars of potential commitments. Right. No one's going to write all those checks, but it's like that we've identified folks that can. But who actually will is another big question. And then once you go, but usually it's like, hey, timing. I can't write the $10 million check. You go through the big check writers and timing. We're just not interested in that market. Whatever it is, and the first week and a half is great. It's like you're getting commitments. Right, everyone's in the deal. Game. Yeah, everyone's like, I've been waiting for a deal. I'm in. And then it slows down, and it's like, hey, I think we called everybody.
Right.
And I'm like, okay, well, have we called everybody? And then it's like, well, okay, let's be patient. We're excited for the deal, but our investors are busy.
Yeah.
And like, just because we sent them an email 2 weeks ago, like they probably saw it, they probably looked at it, and they're like, okay, well, they're going to close in 60 days.
Right. Yeah. Right.
Like, do I need to do this like right now? I want to, and so some of that. So like, if we bug you with a follow up, we're wondering like, well, maybe maybe you forgot about the deal.
Yep.
But also then people are just sitting around waiting. Then all of a sudden they come in because they've been thinking about reaching out, or then all of a sudden they discovered the deal. They've been on vacation and they come back and like, this looks great, or somebody watches an episode of The Gray Report and they're like, oh, cool. I didn't know that these guys were investing with real estate in the Midwest.
Right.
Let me look into it. Oh, they've got a deal. I've been watching your guys' show for like a year. Hell yeah, I want to do a deal with you guys.
Exactly.
And we get a lot of that, but but we get defeated because we're like, we don't know where the money's going to come from.
Correct.
We've got $10 million. We've got to raise. How do we find $10 million in, call it, 2 to 4 weeks.
Yeah. We had a great call with it's an equity broker, placement agent, and those come through every so often, and they're typically everybody's looking for the same thing, to place some equity. And we have what I like to think is the opposite problem of a lot of sponsors, where we have an investor base, we have the capital that is ready to be deployed, but we are maybe shorter on active deals under contract. And this guy was like, hey man, you guys should be happy with where you're at. If people are making deals pencil that they shouldn't be making pencil, they're out over their skis, and now they're looking for capital for a skinny deal, and they got earnest money on the line, and they're going to potentially raise the capital, and their investors may be upset because their returns are going to be suppressed, but you guys are in a good spot. And I like to just continually think that, or maybe not think, know that, because I'm on all these emails with all the broker shops that are sending us deals, and I sometimes get a little frustrated because I'll see a portfolio deal come out of Louisville or Southern Indiana, and I'll see an asset get listed in Fort Wayne, and I'm like, oh, this could be a great project for us.
Yeah, it looks great.
And I'm looking over. I sit next to Addison in the office, so I'm like looking over at Addison, and I'm just kind of waiting for him to pull that up because I get it at the same time he gets it, and maybe not the same time, but I'm like, I want to show him, like, did you see this? But I know
are we going to buy this? Everyone's like, are we going to buy this? Get the right price.
And so it's just like, I see all of the deals that are getting brought to market, especially early in the year. And obviously there's a price upon which it becomes, workable.
I mean, we were underwriting this deal.
Frustrating.
I'm looking at the underwriting this deal.
Yeah.
And I'm like, it's a 6 IRR.
It's crazy.
At what they want. And I'm like, what do they want us to do? And I was like,
Or
okay,
like, what do they
I'm
know
like,
that
what are
we
we,
don't?
what are we missing? I was like, increase. I was like, let's just, how do we make the deal? Not that like we could, not that the assumptions were realistic, but I'm like, what's the math to get to their number? Like, I don't
Right.
understand. Like, I'm trying to back into it. Like, what did you have to assume to justify the returns to get to that
Right.
number?
What is the rent growth? What's the revenue growth? What's the expense growth? Are they, I mean, like, again, I've sat in with Jay and you and Addison and Blake and seen deals come through that are just like, you've got to be kidding me. There's no
Yeah.
way we can get to, what they're looking for because it's
Yeah.
just, I mean, even if you were an all cash buyer, you're looking for, what would you say, 6% IRR? You're going to buy that for 6% yield. Your money's better off somewhere else. It's incredible.
And the only way you can justify it is so like 6 IRRs like this. These are reasonable assumptions.
Yeah.
You can turn it into a low teens IRR.
But now you're speculating.
And then and it's like in a perfect world, if everything goes right, I get a below average return.
Right. And everything's got to go right.
And everything's got to go
Which,
right
like
now.
we know,
But if
doesn't always
if
happen.
I didn't care about like the actual returns, and I'm just thinking of, well, how do we make the numbers work on paper?
Yeah.
I can make the numbers work on. The levers are easy.
Yeah.
Again, it's cap rate, but it's rent growth. If in your rehab, you have to be careful on a value add, but it's like, yep, this makes sense. We're going to increase the rents to $200, and then you're going to get your return. Take that premium out, the deal just absolutely falls apart.
Right.
And so again, like in this particular case where we have to get rents, we have to like move rents to Class A, but it's a Class B, and our renovated Class B isn't going to be the Class A.
Yep.
And the whole crux of it is, and I actually don't think it's crazy, is that, well, the Class A is going to rise. They've been in lease up, so they lowered their rents to get the thing filled up, which is definitely true. They're going to get it filled up, and they're going to increase the rents. And I do believe that will all happen.
Sure.
But I don't know when it's going to happen. And so I'm not guessing. I can accurately estimate, or I can give a fair estimation. But there's really no data to point to, and then to go and raise $21 million. Right. I want to make sure that we have. I have to be so confident that it's a good deal.
Correct.
Because if it's on the margins, I'm not going to be passionate about it.
Right.
And like you and Blake have told me multiple times in the past, it's like investors pick up on that.
For sure.
If it's just like it's a deal that works, it do it, or they can just see it when it's like this. We're excited for this project.
Yep.
And it makes sense. We're passionate about it. We're going to be putting our all into it.
Yeah.
And that's you can't artificially.
I like the idea of having like a defensive business plan. Like I can stand behind it with data on our own portfolio or market data that's like, this is defensible.
Yeah.
And then if you have that, and we do a webinar, a live webinar, a live kind of deal preview walkthrough, where you get behind the camera and you present the deal, and investors can watch it live. They can watch it on recording. The past 2 deals we've done, I can probably name the investors that came to us, watched that, came to us and said, I want to be a part of this deal because I can tell Spencer's excited about it.
Yeah.
I can tell that he's really into this one. And I was like, okay, well, that's great. It's that easy. Just the guy that's in charge, the leader is bought into this market, this asset, this business plan. Well, that's all that it takes. It's a little bit of belief and conviction and sound track record, and here we go.
Yeah, I mean, it's sometimes. I mean, that's why it goes to people invest in people, and not necessarily in the deal.
Yeah.
And people, the reason why we've been able to raise capital in Cannes is not that's because the deals, but it's because people like our strategy, and again, we're in it to like not lose money. We want to find really good, high quality deals, and we're willing to wait and go a long period of time without having any, even though it's very much financially beneficial for us to do deals because we get fees for doing deals, and that's how pay your salary and pay everyone's salary and keep the lights on. And I like the idea of, instead of having to take money, putting it into the business, pay everyone's salary in a year where we don't do any deals. I love to have everyone's salaries covered by the acquisition fees,
right?
And we don't always get to do that every year. People, the volumes are low,
right?
So
this might be too much. I remember for those of maybe that are still listening and they don't know, I came to Great Capital from a very different background with very little experience in commercial real estate and very little experience in investing. And when I first walked in the building, you guys were closing on Sycamore Terrace, I believe. Could have been Echo Park. But I took a look at the underwriting and I was, going from department to department, office to office, trying to like figure out what everybody was doing. I got in with Jay and I was like, so how do you know in year 5 that the rent growth is going to be, 3.5% and you're going to make this much money? And he was like, well, I have no clue that we're going to do that, but that's just a target. And that realization to me kind of changed the way that I view our business and how I talk to investors, because this is a plan. And, even when you board a plane, it has a flight path. Well,
You might have to deviate.
you know how many times that flight path just changes just to get around a little bit of turbulence, or they go up or higher elevation or lower elevation to get where they need to be so that you can reach your final destination. Throughout the whole period of an investment and talking to investors, it's like, look, like the pro forma is there as a guide to tell you where we're hopefully going to land in 5 to 7 to 10 years. The part in the middle, it definitely matters, but we're probably not going to be on track every year on every metric, on expenses, on revenue, on all these things. And it was just this concept that, not that we do this at Great Capital because we don't, but any deal can be financially engineered to show you whatever it is that you want to show you. Going back to the 6% IRR, that if you wanted to get in and mess with the levers, you could get it to an 11 or 12. It's amazing in this time where the syndication space is pretty saturated with operators. And I think it's kind of thinning out, which I think is good, but it's amazing how many investors we'll talk to that unfortunately invested in a deal that otherwise was probably more financially engineered than it should have been. And then the market fundamentals kind of took a turn against the operator. Yeah. So while it might not be entirely the operator's fault in the underwriting, it's kind of two forces kind of intertwining to produce unfortunate results. But I remember just being like, okay, so these are all just guesses, and it's a strategic guess, and it's, there's data behind it, but none of it's a certainty. And I was when my concept of our business really changed.
Yeah. And now now you understand why the data is so interesting, and maybe it's at times a futile attempt to see where things are going. The old saying, the person with the best information makes typically they're going to get the best outcomes from having like the best information, or the most successful man in life,
most informed,
has the best information, not the most information, but the best information. And that's something I think that we all struggle with. Especially me right now, is there's too much data, there's too much information, and so trying to filter the noise out, sort of find a little bit of signal, a little bit of trajectory, parsing like what's real and what's kind of BS, like the CPI number and where to put weights on, and looking at where like the real data is, or what's going on on the ground, and then there's still some intuition that has to come into play that you can't replace. It's never going to show in the data. Yeah. And and maybe AI is going to help us with that. It's at some point, they infer and intuit and find things that maybe we wouldn't as a tool. Working a lot on that recently, but there's a lot of science, there's a lot of art, there's a lot of storytelling, there's a lot of belief, and then a lot of just perseverance. Right. You got to get out there and make it happen. And execution. And whatever. This isn't just multifamily, this is whatever you're doing.
Yeah. I think at the end of the day, most of the time there's human beings that are executing on a business plan, and it's here at the corporate level, but it's also at the site level. Yeah. So it's all, data is king. You can make investment decisions with data, and you can make operational decisions with data. But at the end of the day, there's human beings that are conducting.
Data is not going to fix the toilet from running.
It is not.
It might help you understand how many toilets you're running and how much effort, and should you replace all the toilets. But at the end of the day, like the toilet's running today, we've got to go fix the toilet. And that's why, and then we're going to stop after this, but that's why I really enjoy this business, because it allows it allows me at least the opportunity to one. I was working, with Aiden. Now Aiden's at corporate.
Yeah.
He's working. He's like 3D printing these parts for these washing machines that like we're having to like replace the washing machines. They don't make the parts for it anymore, and it's like a plastic tray piece, but the whole thing doesn't work without it. You can't find. It's very hard to find. You can, but it's really hard to find. And so we get to work on like we're making this little like 3D printed like plastic piece for the washer and dryers, or we're talking about like how do we move snow up at villas in South Bend. But then also we can talk about, CPI and the Federal Reserve and all the macroeconomic stuff that's interesting. Go drive up to Fort Wayne, look at some real estate, and then sit down, with you and do a podcast and talk about all of it. Yep. I think it's great. Just it's can you spread yourself too thin some days? Sure, but it's really exciting.
You forgot the part when you get home and you vibe code.
Oh yeah, that's only been the last week or so.
Yeah,
but I also have to spend time with the wife and kids.
You also forgot that part. Yeah,
that's before the vibe coding. But next week I think we're going to do an AI episode. We're just going to talk about how we're using AI here at Great Capital and how we intend to, and the projects that we're working on. Because I was telling Griffin before this, I haven't gone to bed before. I've got a side hustle that is this job. It's for this job, but I've been basically working between after I put the kids to sleep until 1 or 2 in the morning, and just working on learning how to build internal tools and improve Great Capital systems and Great Residential systems. In some cases, building new systems for different areas of the business. And also I'm hoping for maybe on the first deal, some different ways for investors to like interact with us and our deals, like interactive, like essentially interfaces to explore like deals that you can. We can talk about this. This is a teaser for next week.
Yeah, tune in.
But imagine an interface that has everything about the deal, like literally everything. You can't like necessarily like download the rent roll so I can get everyone's like name, but it has all the information. It's got the model. It has our track. It has everything about Great Capital, and not just like we've put the PDFs into like ChatGPT, but it's going to be a combination of like all of our actual documents, but then like hours of interviews, taking every single transcript from the Gray reports once a week, basically downloading 1 to 2 hours of my opinions over the last 5 years.
Yeah.
Put all transcripts into a database, training a model off of to understand our philosophy, in addition to our investment criteria, what we look for, all of our deals, interviews with employees, training a model. So then you can go and ask, when you want to interface with Great Capital, Griffin, Blake, myself, we're available to interface with our investors. That's what we want to do. But there's a lot of investors who might not want to hop on a call with you just yet. They're not ready to, or there's questions that they don't want to ask you because they're afraid to. I don't know how many times, again, just everyone wants to be nice to each other, which is great, but it's like you're not asking the hard questions. Will be a system that like nothing's restricted. Ask all the hard questions. Ask, how many deals, what's your worst deal? Yeah. Give me all the details. And it's going to be completely transparent. You'll be able to pull up the deal and get all the whole information. Right. And probably the narrative and the explanation of what happened, what we did about it. But you don't have to. You can skip asking us the embarrassing questions and then reach out to us and say, "Hey, this one deal. Tell me about how you turned that thing around."
Right.
Or like, how did you run that thing into the ground? I don't know. That doesn't happen. But you can ask any of those questions you want. And not to mention, being able to conduct your own sensitivity analysis. Hey, stress test this, run a recession scenario. Yeah. What if we did get a refi? What if we don't refi? All of that right at your fingertips, and that's something we'll be finishing up on hopefully soon. But a lot of fun, exciting stuff. Yep. Hopefully we'll have a deal, and hopefully we'll have a deal at some point, but it's got to be right.
It's got to be right. That's been the theme all along
from the very beginning. Can't do a deal just to do a deal. So make sure you're subscribed and hit the bell icon, because then you'll be notified when we drop that next Great Capital AI episode, which I'm sure everyone's going to check out. You'll be able to view that and subscribe to the Great Capital YouTube channel. And we've got a newsletter. Check it out. But thank you for being here, for listening. Do you have anything else? Or we close this one off strong?
I'm going to dangle a carrot because he doesn't know it yet, but Blake Peroni is going to be joining us on next week episode.
It'll be really exciting.
Senior manager, capital markets at Gray Capital.
Multi gold medal Olympian. Blake Peroni is going to be here.
And he has really dug his heels into AI.
We can say that because he's not going to listen to the end of this episode.
Correct. He's dug his heels into AI, and I think that he's going to have some really insightful, useful information for LPs, because Blake's been really trying to focus on how to improve overall investor communications, data visualization, and also deal due diligence for our LPs. And I think Blake's gonna have some surprises for not only you and I, but for their listeners. So come and join us and Blake Peroni in next week's episode as we break down AI in real estate.
See you in the next week.